Jerome Powell, aka your money printer, gave a speech on Friday at the Macroeconomics and Monetary Policy Conference. And he did mention some things that stood out, kind of confirmed a few of my thoughts here. So I thought I'd break that down in this quick hitter and bring it full circle for you so it all actually makes sense. Now, let's get right into it. So the first thing that stood out, now I talk to a lot of people on a daily basis about what's going on in the economy. And for some reason, there's still this widespread belief that we're going back to the zero bound or even close to that zero bound. And it's just not true. Listen to what Jay Powell said here.
I don't think rates will go back down to the very, very low levels they were at before the pandemic. But where they will turn out to settle out, it's hard to say.
Now, if you've been watching me for a while, then you're probably familiar with ZIRP, zero interest rate policy. It's basically us keeping interest rates at the zero bound for an extended period of time, making capital extremely cheap, mainly for larger institutions, which is why we're in this position in the first place, where we've had accelerated bank failures, the 3 largest in history just in 2023. So it wouldn't make sense for Jay Powell to say,
you know what, man? Let's go ahead and take it back down. You know what? We think the banks are healthy now. They're all good to go.
And I'm actually going to do an updated video on ZIRP, get a little more in the weeds to make it make sense to you. But man, if we went back to the zero bound, guys, I mean, it would just literally create the exact same problems 10, 15 years from now. And they would be greatly exacerbated if we did so. Imagine a drunken sailor, or even me being drunk. If the drinks are free, I'm going to keep taking them. If the drinks are 2 cents, I'm going to keep taking them. It's hard to stop at that point. And so that is a huge problem. Jay Powell doesn't want drunken sailors in the economy anymore because they'll take all the free low cost beer and alcohol that they could fucking take in. Now, this next point, I've actually talked about this in my last video on the Goldilocks regime. Essentially, the Federal Reserve faced 2 risks at the moment. The first one being cutting too soon, which would reignite inflation. The second risk being keeping rates higher elevated for too long, putting pressure to the downside on the labor market, which could push us into an actual recession.
At the same time, if we were to see unexpected weakness in the labor market, then that's something that we would be looking at carefully and could draw a response as well.
A policy response, clearly.
Yes.
Yeah.
So they have to walk this fine line and cut at the perfect time for it to make sense, or at least in order to maintain this Goldilocks regime and achieve that soft landing. Because remember, you don't know if you had a soft landing until you come out the other side. And I think out of both of those, I'm pretty confident actually, out of both of those risks, Jay Powell would definitely prefer to cut too soon rather than cut too late. Because if you cut too late, for sure that's going to push us into recession and it's going to affect the consumer because it will start in the labor market because we are at a really restrictive rate currently. Moving on to the next point.
The real question is the possibility of a recession elevated at the current time? And I would say no. I don't see forecasters disagreeing with that. Growth is strong, as I mentioned. The economy's in a good place, and there's no reason to think the economy is in a recession or is at the edge of one, but humility.
Now, I actually agree here 100%. I don't know if you guys would agree or not. Let me know in the comments, of course. But I don't see an elevated recession risk at all. Right now, everything looks fantastic. And I'm just going off right now, guys. And if you're not willing to change with the data, you're probably going to lose a lot of money. I'm just saying. So you got to be willing to change with the data. And right now, we are in a Goldilocks. Everything is looking pretty fantastic. And there are no blaring signs of a risk of a recession on the horizon at all. And even if you like to follow the SOM rule, the last print in February, it was 0.27. So we're still halfway from triggering the actual SOM rule, which tells us we're in the first innings of a recession. I talked about this in one of my videos. Go check it out. But I don't see an elevated risk. That's the point. In fact, and this is coming from a guy who was vehemently against the idea of us achieving a soft landing, man, it seems like we're gonna get that. But I have to think if markets are cyclical, we have to have a recession. But that's the only reason I think there's gonna be a recession, because of the business cycle. But it looks like we're at the expansion phase of the business cycle, which means we have a long period to go before we experience any type of recessionary activity. unless the Federal Reserve didn't cut this year and they kept rates elevated where they are now for an extended period of time. Now, this next point, he was asked about the Federal Reserve becoming politicized in election year, which is this year, 2024. And of course, Jay Powell answered in a Jay Powell way.
The question is, what is your fear for the economy if the Fed becomes politicized?
It just wouldn't. We wouldn't be the Fed. But the good news is we are the Fed. You.
No. That's not answering the question.
No.
But here's the thing: they're inevitably going to feel politicized because, first off, you're cutting in an election year. Inherently, people are going to think you have a political agenda just by cutting in an election year. So we have a meeting in June, a meeting in July, a meeting in September, November, and December. And I'm referring to the FOMC meetings here. I don't think they will want to wait to September to hit that first cut because that's right before the election. So they're for sure going to seem politicized if they do so then. June, I think that will be classified as a bit too early. If you saw this last PCE print on inflation, which is the preferred inflation gauge for the Federal Reserve, it's still a little sticky. And last month was revised up 0.1 on PCE. And so inflation still isn't showing signs of sustainably moving down closer to their 2% target. And so really, although we're getting a 51% chance that's based off the Fed CME tool of a rate cut in June, I think June is too soon. I don't think we're gonna have enough data showing them that inflation has come down to their stated target, which is 2%, not 2.5%. 2%. It's important to keep that in mind. And so July seems like the ideal time for them to cut because it's kind of in the middle, right? And that's still assuming you get more data by that meeting or appropriate data enough that will warrant a rate cut. And one thing he did mention is that we're still looking for more evidence to gain confidence that inflation has sustainably moved down to their 2% target. He's mentioned it every single time he speaks. And if it's one thing we've learned from Jay Powell being the chairman of the Federal Reserve, is that he tries to be transparent. He tries to have appropriate forward guidance so that way he doesn't spook the markets. So it's almost like giving the markets a pacifier, which is why he even came out last week and said the next print on PCE would come in at about 2.8%, which was spot on. Headline PCE came in at 2.5%, 2.5, which was spot on. And core came in at 2.8, which was spot on. And it's also still elevated relative to their 2% target. And so we're not close to that goal yet. I mean, we're closer, relatively speaking, than we were in 2022 when inflation hit 9% on the CPI. But we still have ways to go. And they're still looking for that confidence. And personal spending went up almost 1% month over month, which indicates the consumer is still extremely strong. And so if we were to cut in June, that would for sure ignite inflation or reignite inflation, which we don't want that. So to cap this all off, I still think we're in a Goldilocks regime. I think this is going to be sustained for some time. The Federal Reserve, in terms of monetary policy, and the government, in terms of fiscal policy, behind closed doors, will continue to work in tandem to sustain this perfect economy that we're in. Because at the end of the day, the government and the Federal Reserve, they want to avoid recession if possible. So the most opportune time for a rate cut would be in July. So that way you're not cutting too soon or cutting too late. Now, although there's like 5% of me thinking, okay, there has to be a recession on the horizon here, I still won't operate like there is a recession coming just because the fundamentals and technicals, they're lining up for this Goldilocks regime to fall into a soft landing. And I'll characterize that one more time. Imagine jumping off a plane from the sky. You hit the ground and you maintain a running speed. You don't trip, you don't tumble, you're good. And then you can stop whenever you want to. That's analogous to a soft landing. So although I despise the idea that we're actually achieving this soft landing because it seemed very improbable a year ago, I can't see anything, guys, that tells me a recession is coming. But let me know what you think in the comments, of course. Leave a like as that continues to help me grow. And if you find this type of content helpful, feel free to book a free strategy session, link in the bio. And guys, as always, I'll see you on the next one.